People are joining as we speak, and I see the numbers go up. But quickly, my name is Shuli Galili. I'm the founding partner at UpWest. We're based here in Silicon Valley, seed and pre-seed fund investing cross-border between Israel and the US. And before we start the session, and people are kind of joining, I really want to quickly thank our partners, Google for Startups, and our co-hosts for this session and for follow-up sessions that we will have in the next few weeks. And I want to have Inbal Perlman, who heads the Tel Aviv community for Google for Startups, say a few words about what Google for Startups is doing and welcoming everyone. So Inbal, are you on? Hi.
Hi. Can you hear me?
Yes. Hi, Inbal.
Great. Hello. So hello, everyone. My name is Inbal, as Shuli said. I'm the community manager at Google for Startups campus. Are you hearing me double, just to make sure?
Yes. Yeah, you are. You have a little bit of an echo.
So we're going to try and fix that. Okay. Can you hear me right now better? Wonderful. Okay. For those of you who haven't been to campus before, we're a space to help early stage startups grow with the best of Google. And with the pandemic, we have moved all of our work online, including online events and mentoring and Google Connections. And for today, we're really excited to partner with UpWest, who have been great partners of campus for a long time now. And when we got together and thought of content we'd like to create, we really put an emphasis on making sure it will be based on relevant pain points that we heard directly from our founders. So what you're going to hear today is really that focus, as well for the upcoming events. We have 3 more coming up in May. So in order to remain updated, we invite you to check out our website and subscribe to our newsletter. And I will pass the mic back to Shuli and would like to thank UpWest again for this wonderful partnership and hope you all enjoy today.
Fantastic, and thank you, Inbal. I think that for us at UpWest, we're kind of a cross-border fund and based in both Tel Aviv and Silicon Valley. We always kind of mindful of how founders think about the US market, how they think about approaching it. And when we were thinking together with Google for Startups on topics of, what's kind of the burning issues right now for a lot of founders, we realized through a lot of conversations with our own portfolio, as well as with founders that are more global, is that many of them really want to keep fingers on the pulse of what's happening in the market, what is on the mindset of a lot of investors right now. And I wanted to gather some of my favorite VCs that I have the privilege of working with through our portfolio companies, and hear from them a little bit about what they're projecting for 2020, how they've been handling this crisis, and what particularly and very tactical and practical tips will they have for the many founders who are, continuously logging in right now to listen to us. So for the interest of time, I will introduce each one of them in my own way, but, I think we'll have an opportunity for you guys to talk a little bit more about, what makes you excited and what's on your mind today. But I wanted to add that I'm particularly excited to have these particular 3 investors because they represent 3 different funds who invest, in, I would say, generalist funds, invest across many sectors, as well as multi-stage funds. So they've seen founders at seed, they've seen founders at A, at B, at C, at growth. And so the kind of perspective is so vast that we can really pick their brains a lot of things. So that's why I feel like, we have a kind of a really good representative group here they also invest globally. So that's, I think, is another thing that I think for us at UpWest, made us feel like we can make the most out of this session. Another thing that I think is really unique to these three funds is that they recently raised lots of money, and they've announced, big funds. Lightspeed, I think, was the most recent one that announced a very large fund of $4 billion across, multiple funds. Chris and Victoria at Felicis and Signalfire also in the last few months announced that they raised large funds. So we know that, they're super active right now as well. So I'm going to start with introducing each one of the panelists very briefly, and then we're going to go immediately into questions that, most of them actually came from the audience who were sharing with us, a lot of the questions they had in the beginning of when we started to promote this event. So first we have Chris Farmer, who's a founder and managing partner CEO at Signalfire. It's a 6-year-old fund that announced in December 500 million raised for 2 funds, one for seed and one for more growth stage companies. And Signalfire actually built a unique model for venture capital with very robust infrastructure of expert network, backing companies such as Pango, ClassDojo, and our own shared company, Stamply. And I will later on have Chris, talk about particular sectors he's, been excited about, and we'll have great tips about them. Victoria Traeger is managing director and general partner at Felicis Ventures. I think Felicis was one of the first micro VC funds back in 2006. And grew to be a really incredible leader, I would say, in our ecosystem here in Silicon Valley. Recently announced $510 million fund. Victoria came from a really deep operator experience and had really long-time leadership roles in companies such as Kabbage, RingCentral, and Travelocity. At Felicis, she's on the board of companies such as Hippo Insurance, Centlink, and Ontic. And I can't wait to hear, what she thinks about what's going to happen in some of the areas that she's focusing on. And then last but not least is Arif Jan Mohammed, the general partner at Lightspeed Venture Partners. And he's been investing since 2008 at Lightspeed with strong infrastructure, enterprise background. Some of his investments and board roles are in companies such as Netscope, TripActions, and our shared company, Psycognito. Lightspeed recently announced a $4 billion fund, probably the largest fund that you guys had, and pretty incredible trajectory for Lightspeed, also investing and having offices in Europe and in Israel, and very active in other markets as well. So before we start, quick notes also about UpWest for the founders here who are not familiar. We've been around since 2012, based in Silicon Valley, investing in pre-seed and seed, mostly B2B enterprise, SaaS companies, focused on founders that are innovating in the Israel-US tech junction. So, I would say we have the largest portfolio of Israeli founders in the US, over 35 companies that are based here. We wrote the first checks into companies such as SentinelOne, Stamply, Psycognito, and Honeybook, and continuously being active in those kinds of areas, and excited again to continue and back companies at a very early stage and help them scale in the US. So my first question for the panelists, and that will allow you to kind of talk a little bit about your background and yourself and what you're excited about. I would say, and I'll start with you, Arif, What was your most recent deal and why did you do it?
All right. Can you guys hear me? I just
Yes.
unmuted and I got on Zoom the message that my internet is unstable because I have 2 kids doing Zooms and a wife, so doing a Zoom. So apologies if the connection isn't great. So I won't. I'll talk about a recent Lightspeed investment that actually was announced just as COVID was happening. But as a step back, Lightspeed has a strong history of investing both across the enterprise and consumer stacks. And as Shirley said, we've done a lot of business here in the U.S., Israel, India, China, and we recently opened up offices in UK. And just for context, we're a multi-stage firm. We've got an early stage fund, which is close to 900 million. We've got an early growth fund, which is 1.8 billion, and a global opportunity fund, which is 1.5 billion. All told, 4.2 billion that we announced a few weeks ago. And at early, we'll do seed, we'll do Series A, we'll do Series B. And then the early growth fund is designed not only for new investments for companies as they scale, but also to support our existing investments and lead investments in those companies. So a company that we recently announced that my partner Raviraj Jain actually led is a company called Tonkean, which is behind a very, very talented Israeli founder, Sagi, and his co-founder. And they're really in the RPA, robotic process automation space, where they're using technology to automate a number of human in the loop, very manual intensive tasks that span across the enterprise, whether it's revenue ops, whether it's legal ops, whether it's contract ops, or whether it's financial ops. So wherever human beings are bottlenecks, and human beings can be bottlenecks because we take time to process, because we take time to add qualitative judgment, because we get distracted. We believe that there's opportunity to actually automate these processes, which are time consuming, repetitive, not necessarily high on cognitive load, but really suit themselves to bots. So Tonkean's a company that we're very, very excited about. They've got some very interesting customers that are already using them to reduce time to value by days, just because they're taking humans out of the loop. But let me be clear, they're not putting humans out of a job. They're actually helping those humans focus more on the high value parts of their job and releasing themselves from the manual data entry or data processing tasks.
Great, thanks. Chris, what's the latest out of Signal Fire and that you're excited about and you did?
So yes, thank you for having us. So we've been we do a lot of very talent-driven investing, and then we also have a thematic overlay, a sort of market maps. So most recently we've done a deal in telemedicine called Bicycle Health, which is focused on treatments around opioid dependency. So this is a time where obviously it's very challenging for people to get to doctors, and people who have sports injuries and whatnot, and want to sort of decrease their dependency on Percocet or other medications. This is a way for them to do that safely with a doctor in the loop when it's difficult for them to get to normal healthcare facilities. So
very timely deal.
Yeah, so we've been very active in the telemedicine and future healthcare, consumerization of healthcare as a fund. One, because we feel that ultimately there's no reason that the healthcare industry won't benefit from a lot of the innovations that you've seen in the consumer side originally, and then more recently on the enterprise side, and that it will continue to sort of permeate the rest of the economy, and healthcare being one of the biggest verticals that's been somewhat slow to adopt new technologies because lives are on the line. And so they need to find effective ways to both drive efficacy as well as efficiency and convenience for the consumer in order to increase compliance and ultimately outcomes. So we've been very active in that area as one of them. But there are a number of areas that we as a firm focus on. Signal Fire is run quite differently than other venture capital firms. If you think about accelerators, they're often structured like a university, where you go for, you know, a 90-day period of time and then you graduate and go into sort of the broader venture community. We're structured a little bit more like a hospital, in that as a general partner, I'm more like a general practitioner. And then we have a very large network of experts in all sorts of subdomains that we refer out to, like a hospital. You would go to Stanford Hospital or whatever it might be, and you get referred to a phlebotomist or a podiatrist. You wouldn't necessarily have that specialist on your speed dial, but we do that and aggregate that as a firm. So all in, we have a pretty large team of about 120, if you include all the advisors, and about 35 full-time. And we use that to really support the companies operationally. So we function much more like a technology company and a network, using a tremendous amount of data and infrastructure to sort of coordinate that in addition to the traditional venture activities.
Great. Victoria.
Hi, everyone. All right, so Felicis, we invest from seed through C stages out of one fund. The Felicis Fund 7 is the one that we announced first week of March, which is 510 million. And sector-wise, we are diversified across all sectors. Our largest sectors are health tech, fintech and insurance, vertical SaaS, security, and then infrastructure as well as marketplaces. So those are our big ones. And then most recent deal just announced last week in the security space is a company called Ontic Technologies, which is in an underinvested in area of security. It is in reinvention of intelligence and threat management. So think combination of Kroll, which is obviously all kind of very manual, old world investigations, with alert management and public companies like Everbridge. And very excited about the company. Some of the big reasons we did the deal were the number of Fortune 1000 customers that it had, no churn, 5x year-over-year growth. And they actually signed their largest new deal during COVID, which was really exciting to see, because obviously security becomes even more relevant during COVID. So we can talk more about that one later.
Yes. So, you know, it's really great to see, you know, I think a lot of the questions that initially were for a lot of founders is, you know, are investors investing? Everybody said they're open for business. When in general, we know that when lockdown happened, certain mindset of founders was really actually somewhere else and very different. And I think that what's helpful that I found with, you know, with a lot of our entrepreneurs and a lot of founders that we talk to is to really understand what goes on into a VC mindset when a crisis happened, like a pandemic, like, you know, the lockdown that we happened, and obviously a recession. So I really want, you know, you, Chris, to talk a little bit about that, you know, given kind of the makeup of your hospital fund. How is it, what went on into your head, both from, you know, how you operate a fund and make investments, as well as how you think about the big picture of, you know, we're heading into a major crisis?
Yeah, so again, we're a bit different in our structure than other venture funds in that I'm a CEO. And so we actually have an operating company in addition to the fund structure, which is more like a traditional venture fund where we vote sort of equally across the organization. But particularly when you go from sort of a peacetime environment where things are good to sort of a wartime environment where you have to make much more command and controlled and decisive decisions. And it's harder, you don't have the time to sort of go into consensus. So we immediately flipped into wartime mode, and we parallelized a number of processes to try and deal with the crisis. So the first thing we did is we set the finance team to go through the entire portfolio and stack rank them based on the amount of runway that they had, so we could begin outreach to those companies. We set up a pandemic team to talk to a number of medical experts in our network, as well as other people outside of our network, to make sure that we had the best assessment of what the true situation was, so that we could bring that information in hand to the founders. And then we triaged the portfolio to prioritize which ones needed to be addressed most acutely. and then put the different partners and team members across the portfolio to reach out to those founders, to check in with them, to make sure they were taking decisive action, to deal with, first and foremost, the different phases of a crisis, typically survival, stabilization, and then beginning to move on to sort of planning and for going on the offensive and thriving, hopefully, over time. And so the first thing was just to make sure that nobody was being too lax in work from home and protecting their employees. The health was the most important thing of the workforce. And then after we made sure that we had procedures in place, we put together a number of webinars for the founders to walk through best practices and work from home. We brought in experts on the healthcare side of it and what the projections look like. And then once we ensured that the founders had all taken action on ensuring the safety of their employees, we looked to the safety of their companies. So we immediately looked at how do we shore up balance sheets that where timing was unfortunate and they were about to perhaps run out of runway because they were planning to raise a new round. And so we either tried to facilitate inside rounds or find ways to do notes or whatever it might be to make sure that companies had adequate runway so that they could plan in a more stabilized environment. And then we had one of our operating partners who used to be the chief talent officer of Netflix and Waymo. She started doing a series on how to deal with, stabilizing the employee base. If you have to do RIFs, what are best practices? If you have to do those layoffs, and how do you thrive? How do you do whatever you can to keep the stability and the culture of your organization in line? And then, that was about a 6-week process to go through the portfolio, starting with the most acute needs and then ending with the companies that were profitable, had lots of money in the balance sheet, et cetera, that were less likely to be directly impacted. And we try to overlay a lens of which sectors are going to sort of clearly be most clearly impacted, like the travel sector or companies with physical people in the field. And now, as we've started to exit that phase in the last few weeks, we're now going into sort of future planning on how we can be part of the solution. A number of the companies have accelerated their business models, particularly if they're in telemedicine or online education or home fitness or those types of things where they can be part of helping with mental health and wellness in the home. And then, we started to do planning on what companies might need to pivot their business models. Some companies had physical distribution channels that were no longer going to potentially be viable in the near term. Like, for example, one of our companies sells through dental offices, which are largely closed, and we anticipate that 50% of those companies may go out of business, according to the American Dental Association.
I think that I think that a lot of sessions were handling, for founders, particularly like, the crisis mode of, how much runway you need, what do you need to take care of immediately in times of COVID. And a lot of those, were addressed by their existing investors in March and April. When we look at founders who are now thinking about, great, it's time for me to now go for my fundraising. This is the time for me to go. I have momentum. I'm in the right domain. I need to go and fundraise right now. So, Arif, I want to ask you this question. What kind of tactical advice would you give founders who are now thinking about raising seed or Series A, particularly in terms of, how should they approach it? Both in terms of a lot of the questions were around timing, like when is the right time to go out there? And then questions about tactically what should be the process for them when they're approaching new investors, given
good question.
Giving social distancing, giving the lack of ability to come to partners meetings and meet all of you and all of that.
Yeah, really, really good questions. I think the wrong time to actually go approach VCs was in March and April, when a lot of us were doing exactly what Chris talked about. We went through. It's funny listening to you, Chris, talk about what we did very similar, community-based information handling, a lot of portfolio triage, a lot of conversations with our founders to really help think through what the next year or two will look like. And some of that was drawn on experience from looking at 2008 to 2010 and 2001 to 2004. But, past history is not necessarily a predictor of the future. And this is something that we haven't necessarily seen before because it's invisible, right? It's not economic, it's actually a virus. And as we've gone through that, call it process, now our headspace is clearing, and I suspect a lot of my peers are also seeing their headspace clearing and really thinking forward in terms of how to find the right founders to partner with over the next few quarters. And the advice I'd give entrepreneurs is don't be as rushed. I think, given that there are new restrictions in terms of how much time we could spend together, it's a little bit more challenging to get to know each other because you can't go for lunch, you can't go for dinner. Just prepare to invest a little bit more time in a deliberate fundraise process with investors. And that means spending more time over Zoom sessions with yourself, with the team, really to talk through not only, the business aspects, but the personal aspects. And, how do you find substitution for breaking bread and really, building trust? I think that's a motion that both VCs as well as entrepreneurs will need to build over the next few weeks. And that's something that we're being very deliberate about thinking about in terms of how do we build trust, how do we build a relationship in a world where it's really hard to get to know someone face to face. And I think time is one aspect of that, and investing time on both sides so that there is mutual trust. We were in an environment last year where I think deals were getting done in a week or 2 weeks, and there was a lot of momentum. I suspect that in this new environment, we'll probably see those times to close elongate rather than stay the same.
Victoria, have you seen any change in behavior in the way that you at Felicis, sourcing deals or, interacting with new founders who, being introduced to you or that, approaching you? What has changed in the way you're operating as an investor given the situation, and how do you make decisions in situations like that, and what should founders know about it?
Well, I completely agree with Arif's point around time. Deals are not getting done in 1 to 2 weeks. So make sure that you leave a lot of time to build the relationship. When I look across the deals that we've done in the last 7 weeks of lockdown, one was the company Ontic that I mentioned, where I had met the founder multiple times last year face to face, and spent a lot of time with the founder breaking bread in January and February, and the rest of the team. And then we have a couple of other deals that we have not yet announced that were done purely Zoom deals, where the entire relationship was built via Zoom. And I think one of the things that was really important to those were very strong relationships and networks. So both of the founders came in through warm introductions where we had input about the founders, about the founding team through our network, both of operators and investors. So kind of concept number one there is really working around having a couple of different entry points and recommendations into your first choice venture firms, so that, in the absence of being able to break bread and, look at each other over drinks or coffee, you are having others really stand behind your background and your experience. So I think that's one. The other thing that is important is around what investors are looking for. And I would say on our end, we've always focused on revenue efficient businesses. Revenue efficient meaning that your revenue traction is ahead of how much you've raised and spent. And so one of the big things that you would want to look for is also coming in with a plan that has multiple months, years of runway. 24 is the new 12. That's a big one. A path toward break even, so that you can show that you are looking toward break even and you're thinking about it, is really important. And then sector wise, really focusing on the critical use sectors. The reality is, it's unbelievable the differences. It's almost like the parting of the Red Sea in terms of some sectors have extremely high demand, and other sectors are not so much in demand. And really thinking about, if you're not in one of the critical use sectors, how do you adjust your business model? And to Chris's points, how do you pivot toward more of the critical use sectors or opportunities that have not yet been leveraged?
And, I guess all of you, and Chris, you can answer to that. Do you anticipate terms change for seed, Series A, and so forth, with regards to, what should be expectations of founders, with regards to both valuations as well as size of deals that they will see going into this period?
Yeah, so I agree completely with both Arif and Victoria on take more time to develop a relationship, triangulate through warm introductions as much as possible, and multiple redundancy, if at all possible, so that people can get more comfortable. And if you develop the relationship, just expect more time to happen. So as that applies to terms, I think that it's not homogenous. There are certain companies that are clearly on the sort of fortunate side of benefiting from tailwinds in this market. There are companies who are clearly have headwinds, and then there are companies that have somewhat neutral or maybe slight headwinds, but not sort of directly benefiting or discounting. And I think the valuations for each of those are radically different, and it's much less homogenous across the market. So, for example, areas like telemedicine, things about working from home, fitness at home, mental health, and wellness, collaboration tools and certain cloud infrastructure, et cetera, bottoms up sales models are all going to relatively benefit. Whereas companies with heavy enterprise sales processes that are more top down, while they may not be directly impacted, the fact that you can't meet in person is going to slow down sales cycles and whatnot. And so investors are going to discount future looking revenue projections, and whatever historical capital efficiency you might have had in CAC LTV, for example, is likely to look very different in a future market. And then, then there's obviously sectors like travel, financial services with balance sheet risk, capital intensive businesses, et cetera, that are going to be very adversely affected and are going to be seen at much more deep discounts from the investor community. So I think it's hard to paint it with a single brush. Some companies are going into premium. If you look at the public stock market, companies like Amazon and Netflix and whatnot are actually up during this downturn. Certainly Zoom is one of those beneficiaries, whereas many companies that are solid took a bit of a hit because Facebook or Google, et cetera, but are still strong. And then there are other companies that have just been decimated, cruise lines being or airlines being a canonical example, because things are not likely to go back to the way they were. And so one of the big questions we ask as investors is this a FedEx moment or a toilet paper moment? And then what that analogy means is there was a moment in time in the 1970s where FedEx had sort of really struggled to get off the ground. And then there was a US postal strike, and people were reticent to spend the premium to get overnight shipping. But once they did it and they tried it, obviously many people didn't go back. And it became a breakout moment for the company. Whereas there's other companies, it's more of a toilet paper moment where all of a sudden there's a supply-demand imbalance of commercial versus consumer toilet paper. And so people are hoarding at the supermarkets and sales are crazy on sanitizer and things like that. But that's going to normalize at some point and not be long-term value. And so a big question also beyond the overlays of sort of sectors that are benefiting or not, are these permanent tailwinds that once you have that breakout moment, it's going to be enduring value? Or is it just a blip in time that's likely to sort of go back to a normal state once the crisis is over? And so I think it's, you have to look at it from a number of different angles.
So I think you taking us now into the next question, which is, the areas where we see the opportunities, right? I mean, we definitely have looked into it and started to think about, where are we going to see growth? Where are we going to see demand? Where things are, going to be kind of sticking more in the economy, and what areas are we seeing that, are clearly probably going to be off the board for a lot of investors. So Arif, I want you to address that, in terms of, you've been investing a lot in enterprise and infrastructure and security companies. How do you look at, kind of the next year in terms of opportunities? Are you excited about, and where do you see things that are going to be kind of less interesting in terms of the market?
Yeah, I'll talk about more interesting and less interesting. And what I'll say is, I joined the venture industry in 2008. So, I started in June of 2008, things were going well. And then by September of 2008, things were very, very difficult. And it looked bleak. However, as I look back at the portfolio that Lightspeed built between 2008 and 2010, it was actually a very exciting time for founders as well as venture capitalists, because it was a time for exceptional founders to aggregate talent, to take on very, very difficult problems, and really rethink the way, at least on the enterprise side, how enterprise infrastructure should look. Examples of companies that came out of that time where we invested in Nutanix, which broke down the silos between storage, network, and compute. AppDynamics, which really accelerated performance management for cloud-based applications, and MuleSoft, which under Greg Schott's leadership helped rethink the way that applications are connected and talk to each other. And so looking forward on enterprise, I think where we're not, I'll separate Shuli into two answers. Where we're not necessarily excited is on-premise hardware. I think anything that takes a lot of human beings to install, manage, operate, this is just the acceleration of cloud. And on-premise hardware, where long sales cycles, long testing, I think looking forward will be hard because of work from home, because a lot of IT teams have been furloughed. I think large enterprises are finally going to take a very hard look at their IT budgets, at their IT teams, and say, what do we absolutely have to have on premise, and what can we finally push towards the cloud being either cloud infrastructure or cloud applications. Where we're excited or where we see opportunity is the first derivative of work from home. So, companies that were waiting for chat to take off, for example. I'm an investor in a company called Moveworks, which is building a service desk and a help desk that is entirely chat-based. Well, our initial customers were those that had gone wall-to-wall Slack or wall-to-wall Teams, where chat was, part of a company's fabric. What work from home has done has really accelerated across the world the behavior change of people adopting chat and expecting chat to be a part of the way that they collaborate, whether it's, at least between teams or whether it's across teams. And so we're going to look at more of these companies that take advantage of this new behavior around collaboration. I think distributed teams actually accelerates new types of security. We're seeing in a company called Netskope strong interest for both our cloud-based VPN, which is a new product that they released earlier this year, and their cloud-based SaaS application control and management, as well as their cloud-based infrastructure control and management. I think there's going to be a number of new companies that look at how the distributed software stack plays out, how the distributed infrastructure plays out, and really thinks through how to protect those. Shuli, you talked about Cycognito. This is a company that I think does benefit from these behavioral changes of the adoption of cloud. And Psychognito has built a botnet that really maps out attack surfaces. And the attack surface of the cloud is much different than an attack surface of an on-premise infrastructure. So those are two areas that I think will benefit. The third one is along the lines of what I talked about with Tonkean, which is companies that are using and leveraging cloud plus data plus a lot of the new primitives around artificial intelligence, machine learning, to build new types of enterprise software. Enterprise software that's less rule-based and more probability-based. Enterprise software that is more contextual, that is more personalized, that starts to mimic the behavior that we expect from Google, for example, when we start typing and Google already knows what we're asking. I think that the next generation of enterprise software will be very much machine learning based and probability based, and really tailored to users, and also tailored to doing menial tasks and resolving those tasks in a much better way than a human being can. So those are three areas that I'm
Right.
looking at and very excited about.
Victoria, I want to address your areas of excitement. I mean, clearly you've been involved in some incredible fintech companies, and recently just did a security company. But you and I also talked a little bit about the healthcare space and companies in that domain, where I think a lot of funds are going to start focusing their efforts into that area. Finally, I think we're going to see some more innovation going into healthcare. What excites you about that space, and other areas that you're excited about? And same with RF, is like, what do you think is off the table for you guys?
Yeah, we could talk about this question for hours. I'm a huge, I'll start with, I'm a huge Buffett fan, and obviously this last weekend was the annual meeting, mainly virtual. And there's one thing he said, which I think is especially relevant to where we're at today. We all know Buffett is so pro-America. In the 2008 recession, he said every 10 years there will be rain, and you should come out with buckets to take advantage of the rain. This time he was, I would say, more cautious, and really spoke to this sort of dispersion that we're seeing across the sectors that are hot and those that are not. And so his quote was, he said something like, you can bet on America, but you kind of have to be careful about how you bet. And I think that is the perfect summary of where we're at. So today, all of the companies that Chris was talking about, Amazon, Ring, Microsoft, Cisco is at an all-time high. It hasn't actually hit, it's almost all-time high. It hasn't been at that number in 20 years. And then even a little bit less talked about companies like Intuit, because of the importance of tax, also doing super well. So some of the areas that I am really excited about are in health tech, specifically, where your question started. I think there are going to be telemedicine, obviously, like Chris talked about. But the other area that I think is going to be super interesting is more transparency around healthcare delivery and improving revenue cycle management, improving cost management of healthcare. That hundreds of billions of dollars go to waste in healthcare spending. And so there is sort of a big crop of companies that have come up both on the enterprise and the consumer side. On the consumer side, I sort of think of it as consumerization of healthcare. And there are companies like Decent and Sidecar Health that are really helping you as a consumer take control of your healthcare spending. And it gives you incentives for being more careful about spend. And then on the enterprise side, there's a host of companies that are helping enterprise work between payers and plans, and everything from digital payments, because over 2/3 of healthcare payments still involve checks, service navigation, revenue cycle management, even basic things like provider directory. So all of those, having accurate provider directory, you would be shocked at how much opportunity there is purely in that area. And then mental health delivery, I think we will see massive innovation in this area in terms of both leveraging telemedicine and leveraging sensors to deliver mental health to a broader range of the population. So we're definitely very excited about health technology and actively looking in that area. The other area I like a lot in fintech is fintech infrastructure. Obviously, we're going through this massive sort of I would say a tidal wave that's pushing banks and insurance companies to digital adoption faster than they would have moved if COVID had not happened. And so companies that are enabling automated real-time account opening, KYC, KYB, fraud management, whether it's document fraud or KYC fraud or synthetic fraud, like our company Sentilink is busier than ever, ID verification, all of those, the banks that are still relying on manual processes across all of the different aspects of managing their operations will really fall behind. So we think that's a super important area. Tax is an area where I'm excited about because, like certain types of insurance, tax is mandatory. And then I think Office of the CFO and all of the data companies that are springing up around that function is another very interesting area, both on expense management, AP, CFO tools. Some of the data that I have seen recently around IT spending and CIO spending. Obviously, they're spending much more on remote and security, but they've also opened up budgets on data and analytics. And so data and analytics as it applies to the finance functions and other areas of the business, I think is another super important area. And then I think you asked off the table, the areas that I would say are off the table that where we've invested in the past would be insurance. We're much more careful. So Felicis has invested in, one of our great unicorn companies, Hippo, and we have Health IQ and Go Insurance. So right now we are more careful in insurance investing. The SMB side of insurance, as well as workers' comp, is obviously very negatively impacted. And then we already were not investing in these areas, but even more so the consumer-facing side of fintech, including lending, neobanks. We are not investing in, and instead focusing more on the infrastructure side and platform companies that you're able to use across all the sectors of fintechs.
Wow, that's great. Thanks so much. Chris, we talked briefly before. I mean, I think that you cover, really vast sectors, but also being on a board of ClassDojo and an investor there. What can you tell us, about areas that you're excited about, but also particularly what's happening in the EdTech market and education market? That would be really great.
EdTech has been sort of a lot of the sectors that RF and Victoria have been talking about, I think, are broad themes that have been doing well and have accelerated. EdTech, like gaming, were sectors that I would argue were very out of favor over the last 5 to almost 10 years. It was historically extremely difficult to do an enterprise sales motion into the education system. It was hard to monetize those types of things. I mean, ClassDojo has been a pretty amazing story. I can't give the specific details, but they did something like 20x growth in the last 2 months. Literally, they this week we landed New York Unified School District, LA Unified School District, Chicago Unified School District, all inbound over email.
That's amazing.
It it was just, incredible. And I believe, Victoria, you guys are investors as well. I recall.
Yes, in fact, I'm speaking to the CEO later today, but we also
Yeah.
have a team model where we all work together. Yeah.
And so, but I think, I think one of the real challenges, particularly in education, is that, especially if we have rolling waves of this pandemic, which I think a lot of experts think that we will as we open up until we have a vaccine, the university experience and the premium experience that a lot of education has historically seen is going to be severely degraded because students can't be on campus, they can't get all the activities and the entertainment piece and the social elements of it. And so I think the cost benefit equation was already, frankly, challenged for understanding the ROI for someone's career to invest in education beyond the sort of softer elements. And I think that is only dramatically accelerated in the current environment. So I think up and down. So Class Dojo is building a digital classroom for parents, teachers, and students to communicate with each other. It's a great time to be a digital classroom because clearly the physical classroom is no longer an option. And so effectively overnight, the traditional means had to move and shift in a very accelerated fashion. But I think it will impact all levels of education, whether that's university, whether that's professional retraining, safety. I think there'll be a move towards a lot of virtual education, a lot of online education, remote, all sorts of things around workplace safety and training, et cetera, in addition to university and professional retraining as people recalibrate their careers where they may have worked in a industry like oil and gas or like travel that may be severely impacted for an extended period of time. And now they need to reorient their career to one of the sectors that is seeing, more opportunity.
And are areas that you think are going to be less interesting that you used to invest in and that you think that's not going to happen in the next, couple of years?
Yeah, I think that, so I look at it a few ways. Whenever you have tectonic shifts, it shakes the foundation of industries. So it creates, so some of the most downtrodden categories may see some of the most interesting opportunities. So I don't think we look at it like we would never invest in travel, because the travel sector has been hammered. I don't think we'd invest in airlines or, anything that, that requires sort of the traditional travel, but there may be new opportunities to try and pick up that you may be able to drive to or whatever, camping or who knows what, that may be an alternative to what people can't do today. So there may be certain companies that will thrive, like, in an environment where the whole sector is downbeaten. So I would look at this, we use a little bit more of a lens of, what are the go-to-markets or the business models that are unlikely to be as successful going forward. So obviously in travel, anything that's like heavily group-based or that involves like being in an enclosed environment with a bunch of other people, like I think all of that is off the table. Not that we did much travel in the first place, but companies in the enterprise stack that we would have invested before, but that have a heavy top-down enterprise sales motion, I think we'd be much more cautious today. And so it's not just a sector or a domain that we look at, it's very much what is the business model and the go-to-market, and does that align with the current reality and the potential future reality, even after we adjust to the new normal. And so I think there are, certainly things that we didn't like before, like a lot of capital intensity or balance sheet risk, especially as a small to moderate size fund, that makes it very hard to make great returns. But it especially is scary in an environment like this, where you can't rely on upstream capital. You're very inflexible in your business model because of the capital intensity or physical plant and equipment or those types of things. And so I'd say, the biggest, I think, takeaway right now is it's very hard to predict more than a few weeks out. And any projections over the long term are very likely to be wrong. And so any company that has a business model that is not dynamic and flexible and able to evolve rapidly as the world evolves, I think is going to be a much more challenging place to invest in. And so, as Arv said, anything that's on premise or a lot of physical plant property equipment that you can't quickly change, business models and go to markets that are going to have a lot of headwinds in this environment. Like those are the types of things that we're overlaying on top of industry sectors. But some of the most beaten down sectors are actually where some of the biggest disruptions they're going to have, because companies will break through the historical paradigm and create an entirely new experience.
So if I mean, I guess this is question is like, if you're a founder and you're, seed stage and you did start a company in travel or hospitality or any of these, sectors that are right now kind of in flux, what would you recommend this founder to do right now?
Yeah, so I mean, it goes to the same 3 phases that we did when we triaged the portfolio. The first thing is survival. So I would do whatever is necessary. The first rule of these crises is survival. And then, look towards stability. But I think you have to really look the reality on directly, and not have a sort of rose-colored glasses, this is going to end quickly or go away, or the world is going to change back to where it is. I think you have to assume that it's not going to. So for example, we had a company that called Green Park Sports, which had phenomenal founders, the founders of YouTube and Zappos and Blitz. And they were focused on a fandom platform for Major League Sports. Needless to say, that's a category where there are no, live events going on right now. But these are veterans who have been through the storm before, and fortunately they started with esports, and so there's some huge opportunity there because that's the direct beneficiary on the other end. And now they're working with the leagues to figure out, okay, once you get games going again, but you won't have fans in the stadium packed in, herded, in and out of a fixed building, where it's very hard to socially distance or anything else in that environment. Okay, so now you have to assume it's an at-home experience. So how do we be part of the solution? How do we help these sports teams have a rich experience in the home for their fans, even when they're not able to be in the stadium? And so I think you have to sort of adjust and be part of the solution, even in sectors that are going to be severely, impacted by the current environment.
Final question before, I open it to a couple of questions from the audience. Looking at the US market and where, customer mindsets are and, what are they buying in terms of technology, what are they adopting? We clearly have very global audience here because Google's for Startups outreach, as well as Upwest outreach into Israel. What will be, Arif, I'll ask you, what will be your advice for global founders that are selling into the US market and are not presently here, in terms of how they should think about going to market in times like this?
Well, we've talked a lot about heavy go-to-market models. I think, anything that relies upon getting on a plane to meet a decision maker is going to be severely impaired for a long time. I don't know how long. If we get a vaccine, that may alleviate. But if you're a global company, innovating in and around how you reach your audience, how you reach your buyer, how you let your buyer play with your product, at least on the enterprise side, and really realize value, and then how you convert that buyer to being a buyer, how you convert that user to being a buyer, will be areas where you have to innovate. And there are companies that have really built, great franchises. Atlassian is one that comes to mind that, built a multi-billion-dollar business selling to developers, and that started out of Australia. Right. So New Relic sold to developers and has built a great business really around application performance management. So I would say if you're building any type of software today targeting enterprise, figure out whose life you make easier. Target that person in a over digital means. LinkedIn, for example, is a great way to find people. They're sitting at home, they're a little bored. Convince them to download your product or install your product or try your product. and hopefully your product has enough value that that person will convert and become a paying customer. And don't necessarily optimize on trying to get the highest price out of that person. Try to reduce as much friction on all of the things that I just talked about across the stack, from, you know, reaching these people to convincing them to try it, to convincing them to buy it, and you'll be able to get to people in the US. So it's people haven't stopped buying. In fact, I was a little surprised that across our portfolio, Q1 turned out to be relatively stable on enterprise, and that may be because of some of the factors that these were deals in flight. Q2, a lot of companies are having to really think through, you know, what is a digital way to sell, because you can't go and shake someone's hand. And the ones that are feeling good about Q2 are those that have products that can be delivered digitally, tried digitally, and bought digitally.
Anything to add here, Victoria or Chris?
Sure. Should be a wonderful time for global startups. Geography doesn't matter. You could be literally next door and we're still going to be talking on Zoom. And so, you know, you can now transcend geography, and people are forcing themselves to adapt on how to make decisions, collaborate, purchase, and test new technologies remotely, because you know that they no longer have an option. And so I think, you know, I agree completely with RF that you have to figure out how to sell in this new environment. And the good news for startups is it's extremely difficult for large scale companies that have tons of infrastructure and globally distributed teams, and their whole organizational design is around sort of the old paradigm. And assuming that that doesn't come back, the near term, I think it's actually unlikely to come back ever. I think people will travel again, but once people realize they can be 90% as productive or even more productive on some of these online platforms than they could be in person, without the travel time and the hotels and all the inefficiency. So even if they're 90% as productive, they can do 5 times more meetings. It's way better to do it in the new paradigm, even if you never get a chance to meet in person, or with much less frequency than you would have otherwise. And so I think for companies that are geographically distanced from the end markets, I think really at the end of the day, it's a product that really fits a acute critical pain point. I think a lot of nice to haves are going to be gone, and you're going to have to really focus on what is the must have. And I agree with RF. I would go very much with the land and expand strategy, make it very easy for people to adopt quickly and have the product do the selling. I think, you know, where people are using the product and then you move into adjacencies, you build trust over time, because a big upfront expense is going to be harder to take the leap of faith, and something that's incremental that can expand into something more substantial over time, I think is a model that makes a lot of sense. So I do a lot more freemium, bottom-up selling, a lot more virtual, and I think that companies will thrive in this environment on a global basis because they're no longer limited by borders.
Great. I think we're running out of time, and there were, you know, a couple of questions that I'm looking here in the Q&A. One of them was wondering if any of you are investing in pre-seed or seed stage startups in Israel. What is the best way to approach and apply? Yes, UpWest, definitely apply. Call us, and we're investing. Did COVID change VC's interest in startup incorporated outside the US? Has that been an issue for you at all?
No.
Companies that are Delaware versus incorporated outside? Not an issue.
No, not an issue. COVID has been the great leveling, it's a level playing field. Doesn't matter where you are.
Yeah, Chris, what do you have to say?
Yeah, I would say that as far as investing in pre-seed and seed, we do invest in pre-seed and seed. We're unlikely, it's harder to do that over, you know, a broad geography, just because our infrastructure is more domestically oriented. So we love partnering with folks like UpWest, who have the local infrastructure at the very early stages. And then I think our specialty is like an Israeli or foreign company that wants to focus on the US market as an end market. And that's where we can be most helpful. And as far as the incorporation, I think the most important thing is something that you're incorporated in a place that's predictable, that's business friendly and transparent. And there are a number of options there. There are some tax implications to different geographies as well. But I think it's probably not a key factor unless there's a particularly adverse territory that they're incorporated in.
Yeah, very, very similar to Chris. We're not dogmatic about where a company needs to be incorporated. And then to answer the first question, we actually have 3 partners on the ground in Israel who've worked closely with you, Shuli, over the years. My partners, Yoni Shevetz and Dudu Gusarski and Tal Morgenstein. They've got an amazing office in Tel Aviv, and they've done a number of seed and Series A investments over the last 20 years.
Some of our fastest growing, largest companies were not US companies. Canva in Sydney, Adyen in the Netherlands, Shopify.
Yeah.
Yep, Shopify in Canada. So for Felicis, we focus on finding the best company, and we don't have the presence on the ground, but we really look to Shuli and our partners in key markets like Israel and work with you to help identify, the companies where you're doing the seed or pre-seed, and then we have the chance to get to know them after that stage. So come to Shuli.
Well, I want to thank you guys for taking the time, to really kind of help us and help everybody who attended this to think through kind of the next phase of where we're headed into. I think it's super critical times to do a lot of these kinds of conversations. So thank you so much again. I want to thank my team, especially Gil Bierenboim, who is, orchestrating everything in the background and has done an amazing job. Please stay tuned for our follow-up sessions. We have another one coming up May 12th, where we're going to focus primarily on strategizing for your seed. So companies that are raising seed, tactical advice on that. And we'll be hosting another great investor here from Silicon Valley, Jeff Clavier, who's been kind of a really great seed investor, to talk about that. And then following that, we're going to have more sessions in May. So stay tuned, look on our website for the upcoming sessions, and we look forward to healthy stay home or, not stay home time very, very soon. Thanks so much, everyone.
Thank you so much for having us.
Bye.
Thank you for hosting, Shuli.
Thank you, Shuli.